we've got one last one here. How much return is possible to make on a year? And this is a question I get a lot, and I'll take a quick stab at this and then I'll pass it to Pat. What I always like to kind of throw back right away when answering this question is, well, it depends how much you want to risk, right? Because more risk, bigger position size, more use of margin, futures, options, all these things can get you very big returns,
Yeah.
but it's the glacier underneath the water that it's going to cause volatility and drawdowns, right? And to illustrate this, me and Patrick could take the same exact signals for an entire year. I may only buy 100 shares of each signal, and he lives dangerously. He climbs mountains, and he's done some pretty impressive things in his life. So maybe he wants to take 500 shares for every single signal. Let's say we both had a $100,000 account. Doesn't matter. But the
Yeah.
point is we'll take the same signals. He's going to risk 5 times more. His returns are going to be 5 times bigger. He'll probably have less hair at the end of the year because he's going to go through more drawdowns. Right? I had to sneak one in there, Pat. I
That
get
was
one.
good.
That's it. So it's hard to say returns without risk. It's a
Yes.
constant pull. I can't really pin down to a number because it just depends so much. So Pat, what do you think on this question?
I agree with your statement 100%. And you're not being evasive, you're being upfront, truthful. And I'm the same. I've got the same mindset. We just, it's a function of, as Evans pointed out, how aggressive you want to be. But I'll share this with you. If you say, here's what I'm going to do on, we'll quantify this statement on a breakout trade, a clean and simple base breakout like this, okay? Or I got to show you a couple like this. And please know this. I'm not doing this to brag like, oh, look at this. No. I'm trying to explain. They say a picture's worth 1,000 words. I want to show you 1,000 words over and over and over again. 1,000 words. This one's a little choppier, right? HCC, that's clean and simple, but you got tested here, okay? XLE, it's clean and simple. Do this. On clean and simple base breakouts, go bigger. Now, you can say quantify that statement. 100 shares for one person may be a lot, and for another, it may be nothing. So
Yep.
I'm going to back up here a minute and say something, and this is important. Take your account, and as I said before, let's suppose you want to own a maximum of 10 stocks, and I really think that's the 10 is a lot to follow. I'm telling you. Take your account, divide it by 10. That amount, whatever it is, we'll call X. That's the amount you're going to put in each stock that breaks out. But here's where it gets really important. This is CAN-SIM level 3 and 4. So let's take your account. And again, it doesn't matter what the account size is. Divide by 10. That's the amount you're going to put in each stock. All right? Whatever that number is, the stock breaks out. Your first buy is 50% of X. So let's do numbers here, because percentages can be deceptive. Numbers and percentages, we'll combine them. You're going to put a total of $10,000 into XLE. Your first purchase when it breaks out is $5,000. It proceeds up in price, a couple percent. Your next purchase would be $3,000. Continues going up in price. Your next purchase is $2,000. 5, 3, 2 equal 10. If it doesn't go up in price, the only amount that you had in it is the 5,000. You didn't add to it because it didn't go up in price. Therefore, by default, what does that mean? If it does fail, your loss is much smaller. It's important to think about what you can make, but it's also important to think about what you could lose, which again comes back to why I love clean and simple. Price is good above the line and bad below. It helps us keep losses much smaller. So in a good market, I'll just say one further. In a good market, and the market's a little weird here, okay? Let's cut to the chase. But in a good market, if you are stringent with your stocks and your management of them, you double and triple your money, okay? Without margin. And I say again, no day trading. Please, no 5-minute charts, unless that's your style. If it works for you, good job. So everybody has to find what fits them.
Hey, it's Evan here. I hope you enjoyed this clip from our full-length interview. Don't forget, if you want to hear this entire episode with even more insights from our awesome guest, you can find it by searching the Smarter Trading Podcast in iTunes or on your favorite podcast app. You can also find all of the show notes for this episode by heading to thetraderisk.com/podcast. Thanks for tuning in.